Hey guys, Mike here. So obviously a bloodbath in the markets today, complete sell-off across all sectors, all indexes. I mean, it was a mess. And, am I surprised? No. I mean, like I said in the video yesterday, I say in every video, I think, is the only thing I think we can agree on, it's going to be volatile. And a rally might last one day, might last 2 weeks, might last a month. You don't know, right? And so I was doing the research for this video Tuesday, and I thought, wow, this is the perfect day to put this out because a lot of the members were reaching out to me. Some people subscribe to the channel, all that stuff, hit me up in the comments and asking questions. And so, I decided to finish this research, put it out there to you to show you exactly, basically what we're in, what we're probably gonna be going through, because all you gotta do is look at past stuff, right? And so Nasdaq's in a bear market. The S&P is not, the Dow is not, because they're not below 20%. Okay, the Nasdaq's been in one for a while. And this research is going to show you, I went through every single bear market rally since 2000 is greater than 10%. Okay, not the funnest research, time consuming, as you'll see. But the one thing I'm huge on is in times like this, taking my frustration or whatever and putting it into something useful, right? Like educate myself on this stuff, right? So to give you a visual, to give myself a visual. Like, okay, I see what's going on here, and kind of help me pick and choose my spots. Like, I am going to swing trade or not, or when will I go long on certain things and when will I not, right? But understand, we've been through stuff like this before. This isn't the first time. It just feels like it. And I can, I know the frustration and stuff. Trust me. It's not fun watching any portfolio or any stocks going down. But, you get a big swing like yesterday, and then you get this rug, pulled today by all by the institutions, basically, because this is major selling going on. But this right here should hopefully help you at least get a visual, put it in context. And what it's really meant is to show you hope on the other side, because if you can get to the other side, the pot of gold is unbelievable. It's if you've never gone through this and then coming back up, I'm telling you, anybody that went through 08 and held in there and then put their money in, and rode it up from there, can tell you this is where you'll get your greatest gains, is at the end of a bear market. Okay, and you'll kind of hear at the end of this video why that is. But anyway, I hope you get something out of it. Hit the like, subscribe button if you did, and let's get into it. And so going back to the dot-com bubble, this is the bear market after 2000, and it went on for 2.5 years, and this is just torturous. I mean, I was exhausted just researching this time period, looking at all the ups and downs. I mean, look at this. You think we got it bad now, you think we had it bad in 08. I mean, this right here, you're going to talk about just tearing your heart out multiple times, just sell off, go up, sell off, go up. And so what I did is I broke this spreadsheet down for you guys, and this is Nasdaq bear market rallies greater than 10% since 2000, okay? And this is from 2000 2002. This part is 77% drop in 2.5 years on the Nasdaq. As you can see, these are the bear market rallies. There were 15 of them greater than 10%. Can you imagine that? Total percentage move, you can see some huge moves in there. And then the number of days those lasted, okay? And then some context on the right side right there. But if you can see, as we take the initial drop, then all of a sudden you get these rallies, right? These relief rallies, 12% in 8 days, 20% in 7 days, 20% in 18 days, 10% in 7, 37% in 55 days, 19% in 29 days. And then, of course, you think it's over. Nope. Another 17% drop on the Nasdaq going over the next 6 months, which is torturous. Then you get a bunch of pops, relief rallies, 24% in 16 days, and then here comes the real drops. 42% drop in 2 months. But what happens after that? This is where it pays to learn to swing trade, which is I'm trying to teach myself. 42% move on the Nasdaq in 47 days. That is amazing. Then, of course, we drop some more. You end up getting relief rallies, 34% drop in 3 months, and then there's another one. 43% rally in 77 days, followed by a 46% drop. But along the way, you have more swing trades. And then finally, on October 10th, 2002, hope is renewed with a 93% rally in 1 year and 3 months, which is amazing. And you can see right here, that's the Nasdaq. If you're sitting here getting in on like stocks like Amazon was back then, right? Amazon ends up going up 307% during the same time frame. And then I had to really think hard of what stocks were still trading back then. So this is Qualcomm. You look at Qualcomm, which I know is not a big stock people think about now, but it was back then. It goes up 100% during this time frame. And then one, I can almost guarantee hardly anybody's in, Intel, okay, which actually was a big stock back then. This one ends up going up around 160%. 51% during that same time range. Because you have to remember, obviously stocks go up a lot more than the indexes normally, right? And those were the high growth stocks back in those days. And now fast forward into 08, which most of us remember, in great detail, because I remember sitting on my couch watching the financial sector melt down at that time. And it was painful watching your IRAs and everything else just go down the tubes and wonder when it's going to stop or the bank's going to be open. But when you look at it on the spreadsheet I created for you, it's really not as bad, right? It goes from 2007, 2008, 55% drop in 16 months. Okay, and I've added a few things in here because during this time range, the fear and greed index, stocks above a 200-day moving average, and the put-call ratio actually existed, right? When you're trying to look at like where's the bottom here, where's maybe if you want to swing trade in and out, it's the best time to get in and out. And you can see there was only 8 bear market rallies above 10% versus the 15 during a dot-com bubble. You can see the numbers are much smaller, but you see the number of days, right? You can see anywhere from 1 up to 63 days, okay, on these rallies, and then you get the nice drops. But you can see 10% rally of 9 days, 17% rally on 63 days, 13% in 34 days, 1 day up 13%, right? And you see the big drops on the right, drop 46% in 3 months. And you keep getting these pops over and over and over, and then you get down to where we're close to the end, where you get 13% drop, 21% drop before we finally bottom. You can look at the fear and greed over there, and then stocks above the 200-day moving average, and you can see, I mean, anything below 20 is extreme fear. And you can tell through this whole time frame, we were below 20%. It will pop up above that every once in a while, and then just crater down. The 200-day moving average, you can see right there, that's not good to sit there and have that, but you can see as the stocks continue to drop, what happens to that 200-day moving average? It just falls off a cliff right there. And then the put-call ratio, anything above 1 is considered high. That's where you want to kind of look to maybe try to get in or something like that for a swing trade if you're looking, or if you're trying to time a bottom, good luck to you. But that's extremely high. So basically when everybody's buying puts, everybody's extremely bearish, the world's coming to an end. Usually the market will do a counter trend going the opposite way. As you can see, on March 2009, hope it's renewed again with a 98% rally in 1 year and 2 months. That is massive. Okay, and you can see right there, on the very bottom day where we bottomed out, fear and greed was at 9%, which is extreme fear. 6% of stocks were above the 200-day moving average, which is terrible. And put-call ratio is at 1 at that point in time. And then if you just look at Netflix, it was back then. It's starting to come into its own, so you can see right there. But I'll stop it at the 1 year, 3 month mark, up 161%. But you can see what it did after that. It just absolutely skyrocketed, right? As we started to go on, a rough bull market run, not quite at this point in time. And then, of course, the last one, the most recent one, the Nasdaq was in as far as the bear market, was 2018, when the Fed was doing 4 more interest rate hikes, which would have made it a total of 10. All right, and then they were starting to roll the balance sheet off in 2018. Does that sound familiar? Of course, we did not have the inflation that we have now back then. But the market, at least the Nasdaq, tanked. The S&P and Dow went down to like 19.7%, so it was almost a bear market for them. You can round it if you want to. But you can see right here, it went down a lot faster than what we're doing now. It dropped 24% in 3 months. We're at the 24% mark now, but it's been dropping for longer than that. And so you can see they only had 2 10% rallies in that 3 months. One was 11 days, one was 16 days. You can see where the fear was. Until it bottomed, it didn't even get down below 20, right? So we were in fear on the first 2 rallies. You can see what, obviously, 200-day moving averages, or stocks above the 200-day moving average, around 28, 29%. A lot of puts in there. And, but what happened was you had this massive drop after those rallies of 17% in 3 weeks, which took us down to the bottom. And you can see on December 2018, it was actually Christmas Eve that it bottomed out, and then we had a 33% rally in 4 months. And you can see right there, there's the rally going up, had a sell-off, boom, starts to take off to 2020. So you can see what happens after these bear markets. And that's why you always hear this is where your biggest gains come from, is at the end of a bear market, because it's just like the stocks and the indexes go on steroids, right? And then usually what's happening in these bear markets, you're seeing the government come in and start to put stimulus in the market. Okay, so that's where the steroids part comes from. And that's really almost kind of what bottoms us out, which is what people are predicting this is going to happen too. They're going to raise rates, right, until they break something, start rolling off the balance sheet, throw us into a recession. Then if the playbook plays out, they will freeze rates first, and then they'll announce the decrease in rates. And that's really where you're going to get a huge surge right before you get a major crash, right at the bottom. And then when that happens, then they'll come out and see everything's going to hell in a handbag and say, oh my God, we got to stimulate the economy by cutting rates, maybe throw something out there, start buying bonds again or whatever. And then the market just takes off like a bat out of hell. That's basically in a nutshell. That's the playbook. We'll see if that plays out this time, because this time, for the first time in my lifetime, we have a crazy amount of inflation, right? And people seem to forget, but just if you don't know this, they've changed the way they calculate inflation, I believe, twice now. And so by doing so, a lot of people reported, and it would make sense to me, that if we calculated the same way they did in the 70s, we would be between 15 and 20%, which is basically the crazy kind of inflation they had in the 70s and 80s, right? But of course they recalculate and make it look better for us so we don't panic as much. And so that's where we're at. That's the playbook. And like I said in every video, there's no telling. The only thing we can agree on this year, I think everybody can agree on, is the volatility. Look at the VIX today. Look at the VIX yesterday, right? And so we're back above 30 again. And so that's the only thing we agree on. We know it's going to be volatile. We know there's going to be those moments where you can swing trade up, right? And, have we hit bottom? I'd be surprised if we have, but, you never know. But you're going to have the relief rallies. If that don't show it, I don't know what does, right? I mean, so it's like, being in a car accident every, few weeks or whatever. What I mean by that is you get whiplash, right? Where you're just going down, and all of a sudden, boom, it just takes off. Right, and your head smacks back, and all of a sudden, what happens? Whoom, straight down at some point in time, right? You're just like, your head's getting jerked everywhere, and it messes with your head. It really does. But you just got to learn to walk away from it and not look at your long-term portfolio, pick your spots. And this is the best time. The reason I brought this out was, for those who are still with me, is, it's the best time to educate yourself in this stuff. Because why? We're going to go through this again. We'll make it through this one, right? Everybody will predict the worst crash in history. Who knows? As far as I know, our financial system seems okay, at least the banks, that is. I don't know anything else. But, we're just sitting here. You get through this one, sunlight on the other side, boom, take off, right? And then eventually, once we go into another bull run, we'll run into one of these kind of markets again, and you'll be much better prepared for it, right? I'll be much better prepared. Everybody's much better prepared. So take the time. Take that frustration and put it into something to educate yourself. That's what I always say. So anyway, I'm not going to take any more of your time. Just want to put that out there to you. Hopefully you got something out of it. Let me know in the comments, what you think about that and stuff. And I'll end up seeing you guys later.